I'm Salsabilla Nur Qolbi, and this is my partner.
I'm Jose Christian, and we are from QC Consultant, and we are going to present you our financial analysis of NANNO company.
So here's the table of content. NANNO company profile. The Great NANNO is a holding company established 5 years ago, and they own 5 business units. There are NANNO Farm, NANNO Property, NANNO Bakery, NANNO Mart, and then NANNO Banana Chips. NANNO Farm, chili, tomato, and cabai rawit is what they are farming, and the farming period is in June. And for NANNO Property is a business in selling and buying land and house, and NANNO Bakery, there are 3 outlets in West Java, and then NANNO Banana Chips is selling through online and in mini market, and for NANNO Mart, there are 3 mini market in 3 hotels in Bandung. So, as you can see, this is the company balance sheet overview. Evaluation method, there are common size ratio analysis, and then second, financial ratio analysis, and third, EHP. Common size ratio, sales overview. There are bakery and banana. Half of bakery sales revenue is allocated into its COGS, and a quarter of it is allocated into its operational expense. Fortunately, bakery doesn't have any financial expense, which is enable it to keep 15% of its revenue into its net profit. Banana has a pretty low COGS compared to other business divisions, which is less than half of its revenue. Fortunately, banana doesn't have any financial expense too, which is this enable banana to keep 20% of its revenue into its net profit. Farm net profit is very low since most of its revenue spent into its COGS. Selling and admin expense and operational expense. Fortunately, it doesn't have a lot of finance expense, which means its financial risk is pretty low. This leads into farm having a net profit ratio of 32%. Property net profit is also very slim because most of its revenue is spent into its COGS. However, it has a very low finance expense, which leads it into net profit being 8% of its revenue. Mart. As you can see, Mart has a very high COGS and some finance expense. Its COGS take up almost 75% of its sales revenue, therefore, making Mart only having a net profit ratio of 10%. The conclusion of common size analysis. Therefore, we can conclude that in among 5 companies, Banana and Farm is the most profitable, with the net profit ratio 20% and 32%, and we can conclude too that Property and Mart is the least profitable company, with the net profit ratio 10% and 8%. Not only that, COGS also varies between companies, with Property and Mart having the highest COGS ratio of 70%, while Farm achieves the least COGS ratio percentage of only 20%. Common size ratio analysis, balance sheet. Farm. Inside Farm balance sheet, we can see that Farm may not be very liquid compared to other companies since it only contains 10% of current assets, but contains 8% of current liabilities. However, invests most of its cash in its fixed asset, which can be assumed to be productive assets, which means it chooses to reinvest its cash rather than holding it. Property. As you can see, Property company contains even higher percentage of fixed asset compared to Farm. It also doesn't hold much cash and has high percentage of long-term liabilities. However, this is understandable considering its sector. This means it is safe to assume that Property company takes advantage of leverage lease. Bakery. Bakery can be considered liquid because of its current assets being 150% of its current liability. It can also be concluded that bakery's balance sheet is very balanced, which means it doesn't invest in its fixed asset too aggressively while also maintaining its current assets in balance with its liability. And Banana is the most liquid of all five companies, with its current asset having 23% of total asset, while only having 2% of its liabilities, which the payment may incur in the near future. This also implies a wasted investment opportunity in investing in its biological assets. Therefore, it should have considered investing the current assets rather than holding them. Mart. Mart has an understandably high percentage of current assets, considering its sector of retail. This implies that Mart company needs to maintain its liquidity. Therefore, not investing too much of its cash into its fixed assets may be a wise decision. The conclusion of common size ratio analysis balance sheet. It can be concluded that the property is actually the company that manages its balance sheet well. This is because it reinvests its cash and keeps its money growing through productive assets. This can also be seen through its high percentage of long-term liability, which implies its use of leverage list. Farm also has a similar condition, but without the leverage list. Even though Banana Company is very liquid, it chooses not to reinvest its cash into its fixed or biological assets, which means it missed an investment opportunity it could have gotten. Therefore, the best company are property and farm. And next ratio analysis will be presented by my partner, Jose.
Yeah, and even though property and mart has relatively the same gross profit ratio, their net income ratio differs significantly. This is because they have relatively different other expenses other than the cost of goods sold, which means that mart has a relative significantly higher other expenses compared to property. Next part of the ratio analysis is the return on assets. So you can see that all of those five companies don't have high return on assets, which the highest is Banana at 8%. However, when we take a look on the marginal return on asset, which means the effect change of their growth in their return on asset, we can see that actually all of the five companies except for property have their net income decreased, except for property, which after the growth, the property company actually have its return on assets increased by 21% compared to Mart, which has lost 250% of its return on assets after the growth. This actually a good sign because it means that the property company is actually growing. And after that, we can see the marginal net income. You can see that all of the five companies, except for property and bakery, actually lose money. So bakery don't have any changes in its net income of before and after the growth. Banana lost the most. So Banana's net income after its growth actually decreases by 3 rupiahs, and property actually increases by around 1.2 rupiahs. So yeah, this is actually a good sign for property because it means that for property's net income actually increases after its growth. After the ratio analysis, we are going to talk about their maturity level. As you can see, the property is actually the oldest, therefore being the most mature and the lowest risk, compared to other companies which are not as old or as mature as the property. For example, like farm is 4 years old, bakery is 3 years old, Mart is 2 years old, and banana is the youngest, with only being half a years old. And after the business maturity level, we are going to talk about the AHP method, which is one of the methods that we use to evaluate the companies. This is the AHP method, the ranks from 1 to 5, and the points that we give to each rank in each category. And this is the result, which actually which is actually quite surprising, because property actually came out on top. Followed shortly after is the bakery. The third one is farm. The fourth one is banana, and the last is mart. Therefore, lastly, we can conclude that through AHP method, that we can see that property company is actually the best company among those five companies. This is because conservatively, property company has the lowest risk and is still growing. And what I mean by is still growing is that its net income actually increases when we're considering its growth, unlike all those four companies which are either being stagnant or actually have their net income decreased after the growth, which because their cost of goods sold and other expenses growth are higher than its net income growth. Because conservatively the property company actually has the lowest risk, is still growing, even though it doesn't give relatively high returns. Not only that, looking at its balance sheet common size analysis, you can see that the property company maintains its business decision well by taking advantage of the leverage lease. This is because considering that property has a high net income fixed asset account and high long-term liabilities account. Therefore, they take advantage of the leverage lease. Property also have its net income increases after growth, which, like what I said before, unlike for other companies. The other thing that should be taken into consideration is that property company is the oldest of them all, which means that it has been matured over time. Therefore, it has been proven to work for 5 years, unlike banana, for example, that has only been running for half a year, and already has its net income decreased after the growth, which means it has a really high risk especially when we compare to the property. With those facts in mind, we can conservatively conclude that the property company is actually the best company of them all, while bakery taking the second place, farm in the third place, banana in the fourth, and mart being the worst. And that is all from our analysis. Thank you for watching, and stay tuned.